There we go. Start with exercise number 2 on page 52. On this one, held to maturity securities. On December 1, 2013, Kelly Corporation acquired bonds with a face value of $500,000 for $483,841.79. The bond has a stated interest rate. The face interest rate is 9%, but the yield, the market rate, is 10%. So the market rate was 10%. The bond only paid 9%. So the market penalized the issuer of this bond by giving a price less than the face value. And as I indicated, when we get to Chapter 14, we'll be doing the opposite of these transactions. So I'm only going to talk about this one right now. And I don't test on the held to maturity portion, because if you can do the entry for the issuer, you can certainly do the entry on the buyer. So that's the reason for that. So we need to determine the semi-annual interest rate. So record the purchase of the bond and the first 2 interest receipts. And so the first 2 interest receipts are to be recorded under the 2 options. U.S. GAAP, as you well know, always has options for you. And so the 2 options are straight line amortization or effective interest rate amortization. Okay? So speaking of options, I announced this yesterday. For those of you that took Intermediate 1 already, do you remember the extraordinary item portion of the multi-step income statement that we spent a great deal of time talking about it? It had to be unusual and infrequent in order to qualify as an extraordinary item. Well, I got a notice from the AICPA yesterday. The FASB just released its first standard in a project to simplify U.S. GAAP, whatever that means. So this was the first step. And what did they do? They got rid of it. There's no more extraordinary items. So you will never, ever, your likelihood of ever seeing one was limited to begin with. But you used to have to know what it was for the CPA exam, but it's gone. It's gone. See you, bye. And the crazy thing, I ought to download it and send it out, because the pronouncement, the standard, and that's all they're doing, is just eliminating the extraordinary items. 75 pages. It was, I just went through, what could possibly, it's gone. So, but they went through and every place in all 3, remember 35,000 pages of U.S. GAAP. Everywhere in those 35 pages where extraordinary items were mentioned, they reprint it and then line it through. They just cross it out. So it's 75 pages of crossouts. It's really kind of weird. But anyway, that's gone. So I just thought I'd announce that. All right, so 2013, on January 1, we're going to buy an investment in held to maturity debt securities. And the purchase price was $483,841.79. And we, of course, paid cash. So, we have 2 options at this point. We'll do straight line first, and then we'll do effective interest rates. So on June 30, when we receive the first payment. So we're going to debit cash because we're receiving the first interest payment. So it is a $500,000 face value bond paying 9% interest. And we're paying it semi-annually. So 9% of a $500,000 bond is $45,000 per year. In 2 equal installments, we're going to receive $22,500 in cash. Because this was purchased at a discount, we're going to be, as we amortize the discount on this bond, the difference between the purchase price and the maturity value of $500,000, we're going to be debiting the investment account to increase it incrementally over the 8 payments that we're going to receive until this bond matures, because it matures on December 31st, 2016. All right? So we're going to debit the investment in held to maturity debt securities. And then we're going to book. And so what this is under straight line, we're going to take the discount, which is the $500,000 face maturity, minus the purchase price, $483,841.79. That's $16,158.21. And we're going to divide it by the number of cash interest payments that we're going to receive semi-annually over the life of the bond, which is 4 years. We're buying it on January 1, 2013, and it's going to mature on December 31st, 2016. So it's all of 13, all of 14, all of 15, and all of 16. So we're going to divide this by 8. And that is going to be $2,019.79. So add those to the cash interest plus the amortization of the discount, and we get $24,519.78 as our interest income. Oh, that's a 9. That's an 8 also. Sorry. Yeah, the amortization is $2,019.78, not 79 cents. Oh, where I got the 79 was the line above it, the purchase price. All right, questions on that? That's straight line. And you would do that same entry on December 31st, 2013, the 2 entries of June 30 and December 31st for 14, and so on, the entire 4 years that you held the bond. All right, same exact entry. It never changes under the straight line method.
Is that decided by management?
Yes, it's part of your accounting policies. So just like, do I straight line depreciate or do I use units of production? It's just an accounting policy that you made a decision when you set up the initial books or you first did the transaction. All right? Okay. So now what do you do with the effective method? The cash is going to remain the same. That doesn't change. What changes is the amount of interest income that is accrued. So this bond was sold at a discount in order to provide an effective yield of 10%. All right? So if you take the carrying value, which on the first payment is the 483,841.79, and you multiply it by 1/2 of the 10%, because the 10% yield is an annual rate, so this is a semi-annual payment, so multiply it by 5%, you will get interest income of $24,192.09.
Sorry, why is it 5%?
Because the yield, the discount that was on the built into the purchase price, had an effective yield of 10%. That's what it told us in the problem. All right? So if it's a 10% yield on an annual basis, semi-annually it's 5. Okay? The difference between the cash that we receive and the interest that we earn is the amount of amortization. In this case, $1,692.09. With the effective interest rate, this calculation is now going to change every time we make an entry. So on December 31st, we're going to debit cash, and we're going to debit the investment in held to maturity. Debt. And we'll credit interest income. So now we're going to take the 483,841.79, and we're going to add what we just amortized back on June 30, 1692.09, and that's going to give us 485,533.88 as our new carrying value. Multiply that by 5%, and we'll get interest income on December 31st of 24,276.69. We're still receiving $22,500 in cash. And so now the difference between those two is an amortization of $1,776.69. Yes? Does everyone understand? I'm going to do another one just to finish this up. I'll do one more debt security before I move on to the equity. And on this next one, I'm going to do the full amortization table that is needed to make these calculations. All right, but does everybody understand how we're doing the effective interest rate method right now? So far? Okay. Has everybody got this? Can I erase? Is everybody, some people still writing. I know it's an absurdly long account name, isn't it? Investment in held to maturity. I'm going to abbreviate it this next time just to make it a little faster. Okay? We good? So we're going to do exercise number 5 on the next page, on 53. Yes? I heard somebody say something? No. But somebody was saying, no, don't erase it. And actually, I'm going to abbreviate this because I need the other half of the board. So it's going to be investment in HTM. So you know what the whole account title is now by this point. All right, on this one, on January 1, Rogers Company purchased a $200,000 face value, 10%, 3-year bond for $190,165.35, a price that yielded a 12% effective annual interest rate. They pay semi-annual interest on June 30 and December 31st. So on this one, the debit is the $190, the cost of the investment, and now what we need to do is create a table. So we have January 1, 13. We're going to have June 30 and December 31st. Oh, what's going on with these pens? And then you're going to have June 30, 14. And then lastly, the same two dates in 15. So we have cash. That's going to be a debit. And then we have interest income. That's a credit. We have our amortization. And because it's a discount, it's also a debit. If it was a credit, we would be paying more than the face value for the bond. And then as we amortize the premium on the bond that we bought, we would be crediting the investment in held-to-maturity debt security to bring down the carrying value. So on January 1, the carrying value is the purchase price, the $190, $165.35. This bond was purchased at a discount to yield 12%. It pays semi-annually over the 3-year life, so the interest income is going to be based on 6%. So everyone understand that? It's a 12% annual yield, so 6%. Multiply the 6% times the $190,165.35, and you get an interest income of $11,409.92. It's a $200,000 bond that is got a face interest rate of 10%. So that's $20,000 a year in interest, cash interest, paid twice a year. So $10,000. Every 6 months for the 3-year life of the bond. All right, so the difference between the interest income that we're going to accrue and the cash that we received is the amount that we amortize, $1,409.92. So am I going to add or subtract that to the carrying value? Add, because what does this need to be on the end of 2015? $200,000. Very good. So now we have 191,575.27. Repeat the process. Multiply that times 6%, and we get 11,494.52. A difference of 1,494.52. Which brings us to $193,069.79. On June 30, 2014, we'll then have 11,584.19 in interest income, amortization of 1584.19, bringing our carrying value to 194,653.98. 11,679.24. 1679.24. We're now at 196,333.22. 11,779.99. And we're finally at 198,113.21. And our very last interest payment will earn us $11,886.79 of interest, and the remaining $1886.79 will bring us to what we already knew was going to be the face value, the carrying value of the investment at the date the bond matures. And at that point, the bond issuer will write us a check for $200,000. We'll debit the investment in held-to-maturity debt securities. We'll debit cash and credit the investment in held-to-maturity debt securities, and that will take it off of our books. So the interest payment, and I'll just do the first one because on June 30 is we're going to receive cash in the amount of the $10,000 interest check that they send us. We're going to debit the investment account. By that first amortization number, the $1,409.92, and we'll credit interest income by the $11,409.92. Could not be easier, right? Now it makes perfect sense, right? Yes? You're all thinking secretly, I hope I don't get this question. I hope I don't get this question on the CPA exam. It's just time consuming. The math's not hard. It's just, And as I said, we're going to see the exact opposite of this transaction in the next chapter. Because at that point, we'll be selling the bonds, so we'll be debiting cash, crediting bonds payable, and then debiting discount on bonds payable. And we'll amortize it exactly the same way, except now rather than interest income being a credit, it'll be interest expense being a debit. It's the exact same technique, just the other side of the transaction. All right? Okay, let's go on to equity securities. Exercise number 9 on the same page. On this one, Southeast Bank invests in trading securities and prepares quarterly financial statements. At the beginning of the fourth quarter of 2013, the bank had one security, Eglin Company, of which they owned 200 shares that originally cost them $5,500. But at the beginning of the fourth quarter, these securities had a fair value of $5,200. So the difference between trading securities and available for sale securities is trading securities is your core business. Management intends to buy and sell these securities for short-term gains. So because management's intent, and this is a bank, so you commonly see these in financial institutions, brokerage houses, insurance companies, things like that. Because of management's intent, we get to take unrealized gains to the income statement and actually report them as part of our calculation of net income. So as the stocks or bonds, it's stocks in this particular case, but it could easily be bonds. So as the securities rise and fall, we're taking that to the income statement because that, in the case of some investment firms, may be the only thing they do. They would have a completely blank income statement, or it would be less than what it really is. I mean, because all they would be reporting is the realized when they actually sell a stock. And so we want to accurately reflect their period's endeavors on the income statement. So we get to let them take that. That's not the same with available for sale securities, which was what the last problem I'll do today will be, which will be the next exercise. All right. So we have this one stock in our portfolio that has gone down in value. We wrote down the investment account, as you'll see here in a second. You actually write the investment account down to this $5,200. So then we engaged in 3 transactions throughout the fourth quarter of 2013. On October 26th, we bought 300 shares of Farrell Company for $35 a share. So October 26th. We make a debit to investment in trading securities. And we credit cash for the 300 shares at $35 a share. So that's a total of $10,500. Then on November 26th, we sold the 200 shares of Eglin Corporation common stock that we were holding on to at the beginning of the quarter, and we got $25 a share. So on November 26th, we're going to debit cash for the 200 at $25 a share. That's a total of $5,000. The problem told us that at the beginning of the fourth quarter, the end of the third quarter, we wrote down that investment. The original investment was $5,500, but the fair value of those 200 shares at the end of the third quarter was only $5,200. So we've already taken a $300 loss on this stock. But now we're selling it for $5,000. So we have another loss. And this one is now realized. So it's loss on sale of trading securities. For the $200. And then we write off the investment. The $5,200 fair value that we had at the last balance sheet date. And then lastly, on December 10th, we bought 400 shares of Gray Company common stock for $41 a share. So December 10th, we debit investment in trading securities. And we credit the cash for 400 at 41. So that's 16,400. So now we need to determine the fair value at year end. So we have two shares left, two stocks left, 300 of Farrell and 400 of Gray. Farrell cost us originally $10,500 and Gray $16,400. Because they were trading at 35 and 41 respectively at the moment we purchased them. Now, at year end, they're trading at $38 for Farrell, so Farrell has gone up $3 a share, and Gray is $40, so it's gone down $1. So the fair value of the 300 shares at $38 a share is $11,400, and the 400 shares at $40 is $16,000. So that's a change, an increase in our investment of $900 for the 300 shares of Farrell, and a decrease of $400 for our 400 shares of Gray. So our totals this is $26,900 This is now $27,400 aggregate fair value of our entire portfolio. A net change of $500. So the December 31st entry needed is because this is a trading security, so we're going to be taking the unrealized gains to the income statement. For that reason, we write up the actual account. So we're going to debit investment in trading securities. And we're going to credit unrealized holding gains, gain or loss, and in this case it's a gain, on trading securities. And that's the 500. So under long-term investments on the classified balance sheet, we would have a line item, investment in trading securities, and it would total the $27,400. Where would the $500 go? The income statement. All right? Questions on trading securities. So to compare and contrast, we'll do the last exercise of the day before I let you go for our long weekend. On the next page, page 54, we'll do exercise number 4. And this is available for sale securities. On this one, December 31st, 2012, Marsh Company had 1,000 shares of Xenon Company common stock in its portfolio of available for sale securities. The stock had cost $15 a share and had a current market value at that balance sheet date of $13 a share. So it had gone down $2 a share for the 1,000 shares, or $2,000 total in aggregate. So the balance sheet entries, because this is available for sale securities, you have the original investment account, $15,000, that's $15 a share for the 1,000 shares, less an allowance for change in value of investment, so that you have the net of the $13,000. The other side of that $2,000 unrealized loss does not go to the income statement, because management's intent is not to sell these stocks for short-term gain. Management's intent is to hold on to it. We're buying it for reasons other than trading gains and losses. Maybe securing a supply chain, an important vendor that has to give us a component in our manufacturing process. We may be buying it to gain access to some technology. There's a whole slew of reasons to go out and buy stock in other companies. All right? So, during 2013, Marsh went out and bought 900 shares of Yellow Company stock at $18 per share, and 800 shares of Zebra Company common stock for $22 per share. And then at the end of 2013, the market prices for the three stocks in the portfolio are 14 for Xenon, 17 for Yellow, and 20 for Zebra. So record the purchases of the 2013 investments, and then what adjusting entry would be needed at December 31st. So it doesn't give us a date for the two investments, but we have now, we're debiting investment and available for sale. Credit cash. For this first one, for Yellow Company, we bought 900 shares at $18 a share. And that's 16,200. 16,200. And then we bought Zebra. $800 shares at 22. That's a total of 17,600. All right. So at the end of the year, we have 1,000 shares of Xenon. We have 900 shares of Yellow. And we have 800 shares of Zebra. So the original cost on each of these shares are $15,000, $16,200, and now $17,600. A total portfolio of $48,800. So the Xenon is now $14 a share for a total now of $14,000. Yellow is now trading at $15,300. And Zebra is now worth $16,000. A total of $45,300. And it's a good thing that the portfolio manager is not in the business of buying stock, because he lost money on all of them. So there's $1,000 down on Xenon, 900 on Yellow, and 1,600 on Zebra. A total loss of 3,500. So on December 31st, we need to take an unrealized holding gain or loss, this time on available for sale, and our credit is an allowance for change in fair value of investment. And because we've got the whole portfolio is in a loss position, this credit balanced account is going to be a contra asset account to the original investment in available for sale securities account on the classified balance sheet. So, yes, sir.
If it was a gain?
It would be the opposite. You would be debiting the allowance and crediting the unrealized holding. So the million-dollar question is, the last one I'll ask before we take a break for the weekend, is how much should we be debiting and crediting? And it's not the $3,500. That would have been too easy. How much? 35? 25? No. Now don't look at this. Just focus on this. But what happened at the end of 2012? We had a balance in the allowance account. So if I do a T account, had a credit balance of $2,000 in it at 12/31/2012. We now need a $3,500 balance at 12/31/13. So how do we get from one to the other? Exactly. And next Thursday, when we finish this, I'll be doing more complex ones that'll show you what happens when we sell one of the stocks out of an available for sale portfolio, and how do you handle the sale of a stock, because that also is different than the trading security. All right, questions on this? No?